Thank you for joining us today for the WAM Income Maximiser FY2026 Interim Results Webinar. My name is April Lois, and today I'm joined by WAM Income Maximiser Lead Portfolio Manager Matthew Haupt and Portfolio Strategist Damien Boey. Before we begin, a disclaimer is displayed for you on the screen. What we will discuss today is general in nature and is not financial advice. To start, I'll give you an update on the WAM Income Maximiser's half-year results, and then I'll pass over to Matt and Damien, who will provide a market update and discuss key themes. We look forward to taking your questions towards the latter part of the webinar. So let's start with the investment portfolio performance. The WAM Income Maximiser investment portfolio outperformed its benchmark by 4.9% in the 6 months to 31 December 2025, increasing 8.3%. The benchmark is comprised of 60% of the S&P ASX 300 Accumulation Index and 40% of the Bloomberg Ausbond Bank Bill Index plus 1%, and returned 3.4% for the period. Since the IPO on the 30th of April 2025, the investment portfolio has increased 11.6%. Sorry, that's it. And apologies, my computer's just having some problems, outperforming its benchmark by 1.2%. WAM Income Maximiser has delivered strong investment portfolio performance for shareholders in its inaugural year and provided shareholders with an annualised March 2026 grossed up dividend yield on the IPO price of 6.3% when including the value of franking credits. The March 2026 monthly fully franked dividend of 0.55 cents per share was declared as a result of the profits reserve, capital profits reserve, and franking credits available at 31 December 2025. I will now hand over to Matt, who will provide a market update.
Great, thanks April, and thanks for everyone for joining us today. First of all, I'd like to thank everyone since the IPO. It's been a pretty wild ride. We started with Liberation Day around the IPO into private credit issues, into global conflict now. So been a real rough ride, but what's really pleasing is we are ahead of schedule. So when we came to market, we said we will get the dividend yield up to the full run rate within 12 months, probably being 12 months. We're actually about 4 months ahead of schedule. So the run rate is, as April pointed out, running at that running yield now is running at our target. So that's incredibly pleasing in a very difficult market. So it really goes to show the benefit of having this portfolio structure in these volatile markets. So really, really happy with portfolio performance. When we look at the markets now, I mean, Damien will touch on some of our outlook, but I guess what I want to walk through is some of the benefits of this fund. At the moment, our cash weighting is fairly muted, but the benefit is we can move a lot of our money into some of these bonds at the moment. So we're actually upping our bond equity, our bond weightings, and pulling down our equities slightly. But again, this has been demonstrated over the period since IPO. We can pull these levers, and we've pulled them quite hard over the period. So very, very active management, which is you can see in the numbers which were generated, that outperformance. So for the real highlight for us is that running yield ahead of schedule. A lot of people were confused about the yield was low at first, but when we came to market, we said it would be a 12-month process. And to deliver that ahead of time is very pleasing. So for us, product is working really well. It's been stress tested in the hardest and toughest environments and come out with a really big outperformance, which has been great and very rewarding for shareholders, which we'll start to see the benefits of the dividend, that running yield being high now, and also building that profit reserve so we can keep paying the dividends despite market dislocation. So with that, I'll hand over to Damien now, who can walk through some of our market outlooks, and then we can go to Q&A after that.
Sure, thanks, Matt. So just to recap very quickly our process. So we do try to combine different strands of idea generation. So obviously we do our work on the fundamentals of every company and security that we're investing in. We take a lot of account of the macroeconomic circumstances, and we also look at market positioning. So we don't want to be too much with the crowd at any given point in time. Now, we obviously do that across the equity universe. That's what we've done for a long period of time here at WAM. But the important thing is we also do it within the debt universe. And there's a lot of synergy in doing things this way because the companies that we invest in on both sides are the same companies. Now, if I go to the next slide, what are the benefits of WAM Income Maximiser? Firstly, you get that monthly fully franked dividend. We are the only LIC in Australia that invests across debt and equity. And when it comes to the debt securities, what's really important to note is that a lot of the things that we invest in are not generally accessible to retail shareholders. So we're giving that access. We are, as Matt highlighted, very active managers. We have many different levers that we can pull to make money in different sorts of market environments. And, if you're there thinking about hybrids for banks being phased out, well, this is an enhanced version of a hybrid. It's not even, I would say, just a replacement. It's an enhancement. It's got all those debt and equity characteristics, but most importantly, it has that additional layer of diversification built in to give you higher returns with lower volatility. Just to give you an illustration, a very basic illustration as to what we mean by all of this, because I know sometimes it's more helpful to look at things in a tangible way. If I go to the next slide, here are a whole lot of things that you could invest in if you wanted to invest in Commonwealth Bank of Australia. And this is just a random example, but it's a good one. You could, for example, decide to put your money into a one-year term deposit, offering you about 4.7% interest per annum. And of course, you'd be subject to a deposit guarantee with the government up to $250,000. That's kind of the safe end of town. Alternatively, you could go all the way to the other end, which is equity. And at the moment, CBA shares are giving you a dividend yield, which interestingly enough is actually less than the term deposit rate. Now, when it comes to companies and capital structure, the way it works is that there's a pecking order of claims. So if a company has borrowed money and suppose it falls on hard times, then the first people to get paid their money are what you call secured creditors. And sure enough, CBA offers you secured bonds if you are so inclined. And they offer you an interest rate which is only slightly above the term deposit rate. Then you have what's called the Tier 2 universe, which are basically a bit lower down the pecking order, and they come in different varieties. So, for example, you could buy floating rate notes that they offer you interest payments that go up and down with the RBA cash rate. Or you could buy into stuff which is offering you much longer dated fixed interest rates that don't move with the RBA cash rate. And then, of course, if you move further down the risk spectrum, you've got hybrids, which are being phased out at the moment. And the thing about hybrids is that, they're debt instruments that pay you somewhat franked dividends, but then at some point and under the right conditions, they can be converted into equity. The reason why I point out all of this diversity in the way CBA investments actually operate is just to show you that we actually operate at every part of this capital stack. We can invest in any part of it. And what we want to do is invest in the best part, risk adjusted at any given point in time. And so you can see from this chart here, well, actually investing in the middle of the capital stack in the Tier 2 bonds, particularly those that are fixed rate. So I've got them here, T2 FXD. They're actually offering you really, really high yields at the moment. So we think that this is a really good spot to be in. And as Matt highlighted, we're increasingly rotating our portfolio towards this. If I go to the next slide. The reason why we're investing across all of these different types of instruments, first and foremost, is to get you a good return, but with lower volatility than the equity market. So volatility just simply tells you about, if I hold an investment for a year, what sort of price movement or what sort of performance variation would I expect? And so lower means that you're in a safer investment. What we've got here at the moment is our portfolio is operating with an annualized volatility performance of around 6.8%, and that's quite a bit down from if you just invested in the ASX 300, which is pushing that volatility closer to 8%. The underlying yield that we generate on the portfolio, so what we receive in the form of dividends from companies and interest payments on debt, the weighted average of that grossed up for franking is about 4.1%. Seems a bit low, but I'll come back to that in a minute. The most important thing is what we call a Sharpe ratio, And what that tells you is for every dollar of risk that you take, how much return are you getting? So, if you put $1 at risk and you got $1 back, well, that's okay. But fortunately for this portfolio, the reward to risk ratio is closer to 2, which is actually really, really good. So we're pleased to say that in the time that WMX has been up and running, we've actually managed to hit all of these objectives: higher returns, lower risk, and a decent stream of dividends coming through. Now, if I go to slide 9, slide 9 basically shows you, I guess, where our performance is coming from and how it compares to the benchmark that we've set ourselves up against. So we have, as a minimum threshold for dividend payments, and I emphasize minimum, we've set basically the RBA cash rate plus 2.5%. And over the prior period, that's averaged around 6.2%. And you can see that in the very first column on the left. In the second column, what you can see is that we've actually achieved this required rate of return if you invested particularly at the IPO price. And that is an annualized number, and it takes into account a bit of franking. So right now, we have already hit the minimum run rate for dividends on an annualized basis. And hopefully that's something that shareholders will be able to notice going forward after the ramp-up phase that we've just gone through. Now, as we suggested at the IPO, the plan is to gradually increase these monthly dividends up to a rate that we deem acceptable. So the good news is that we're already at the required rate. And the question really, which is a board decision, is how much can we ramp it up further? Now, going forward, we do aim to provide investors with a combination of capital growth and income, with the monthly dividend being the target income return. Additionally, the dividends above and beyond the target income return can be paid out to shareholders depending on portfolio performance, which includes, of course, capital gains. But we want to emphasize that that is a board decision. Now, the third and fourth columns really speak to that point because they show you the average performance of the WMX portfolio since the IPO. And what we've done is we've split that up into different components: the passive income from just dividends and interest income, as well as the capital growth. And because of the fact that we do have a multi-asset fund, and because it is actually actively managed, the far right column shows you how we've actually gone versus the third column, which shows you our benchmark. And we're pleased to say that we've significantly surpassed what the benchmark would have delivered. And the reason why we've been able to do that is because we do have debt and equity. So our portfolio has been freed up by the income that we're earning on the debt portfolio to pursue tactical and strategic growth opportunities on the equity side. That's the reason why we've managed to outperform our benchmark. Now, if I go to the next slide, here's a snapshot as to where we sat at the end of January, and this is obviously evolving as we speak. We were basically around 25% debt and 75% equity in the underlying core portfolio. And if you look at the composition of that debt, it's very skewed towards high quality or A-rated debt. And more importantly, the skew is actually moving from floating rate notes that go up and down with the RBA cash rate to fixed. So these are movements that these are adjustments that we've been making through time. And as Matt highlighted, we are actually continuing to move the portfolio in favor of the bond portfolio and in particular the fixed rate instruments. Now, if I go to the next slide. Okay, so as we said at the outset, we really do want to combine the best of micro and macro with positioning. So we do look at a lot of leading indicators of performance. I won't go through all the details now as to how we come up with our estimates, but the important point on this chart is to show you that we do actually have forward-looking estimates of returns across all the different things that we could possibly be invested in. And right now, what we're finding at a global level, and I emphasize global, is that commodities actually look really good relative to the rest, and in particular relative to corporate credit. That is the global picture. And that's underpinned by basically having a lot of liquidity in the system at the moment. If I go to the next slide. Within the equity portfolio, there's lots of different ways that you can slice and dice stocks. Different sorts of investors like to invest in different ways. But one of the most important things that we want to highlight here is that the case for having more quality in your portfolio, so companies that offer you better profitability or more safety or more robust returns through the cycle, that's actually increasingly what we should be wanting from here. And that's, in fact, what we are doing. If I go to the next slide. What I've got here is just a few charts to show how uncertain we are and the shape of the uncertainty. So it's all fine and good for everybody to say, look, these are uncertain times and we don't know what's going on. But actually, I think we can do a bit better than that. So if you look at the top left-hand chart here, it shows you what the equity market is pricing in terms of uncertainty. It shows you what the bond market is pricing in for uncertainty. That's what we call the MOVE index. And then it talks about what people in the general public are actually feeling about uncertainty, particularly when it comes to the state of policy. The fourth one, the grey line, actually shows you how uncertain we are about artificial intelligence and disruption therein. And so it's really interesting to see that AI uncertainty is rising and has risen to a very high level. And of course, if we were to update this data all the way to the present, the political uncertainty has gone up quite a lot. So it's really important to know what sort of risk environment we're in so that we can manage our money in a risk-adjusted way. Now, what you would have also seen on the bottom left-hand chart is that particularly during the reporting season, there's huge dispersion between those who have actually managed to please shareholders and those that haven't. And obviously AI disruption and some of the concerns there have fed into some of that volatility beneath the bonnet of the broader stock market. The bottom left-hand chart simply shows you that the amount of switching that people are doing between stocks, the amount of dispersion that there is in performance, that sort of risk and that sort of volatility underneath the bonnet is actually rising much more rapidly than the overall equity market is proving volatile. So that is another source of risk that we need to be thinking about. We want to give you diversified returns. And the way that we get diversified returns is hopefully the different things that we invest in, some move up, some move down, but on average you win. So what that's called is a regime of low correlation where things aren't moving exactly in sync together. Unfortunately, what we're finding at the moment is that things are moving very much in sync. So bonds and stocks are moving together, bonds and commodities are moving together. Those sorts of really weird sorts of developments, they are what they are, and we're positioned accordingly for it. I guess the overall message here is that uncertainty and correlations are really high, and that does make it difficult to manage risk, but we're on top of a lot of those things and we're actively monitoring it. If I go to the next slide. So a lot of people will tell you that there's a lot of uncertainty about rates, and that's true. But I think it's important to understand why they are uncertain. When you look at a 10-year bond yield for government bonds, you can actually break down the bond yield according to two different components. One is what people actually expect inflation will be over the life of the bond, and the other part is what we call the real return. What we think is happening at the moment is that the inflation expectations are going up, but because of the fact that policymakers have generally pretty good control over the system, they're managing to push the real yield component down. And so the two components of the bond yield are moving in opposite directions. That's the reason why people are uncertain. But that's not something to say that we don't know what to invest in. Actually, that is a very clear investment proposition. Our modelling and our outlook suggests that some of the inflation pricing in bonds can still go up. And one of the really interesting things about this is that if you expect inflation to go up, one of the best investments to be in, of course, is in the commodities complex, as we alluded to earlier, and in particular here, oil. So we think that there are some pretty tangible investment conclusions, even if you have a mixed outlook for where rates actually go globally. Now, before I emphasise that the outlook for commodities globally is better than the outlook for bonds and credit globally. That is a global conclusion, but we don't just invest. We're not in the global arena per se. We're much more focused on Australia. So if I can go to the next slide, what that shows you right now is that actually Aussie bonds are tremendous value, particularly if you can fix the interest rate for longer horizons. The consensus at the moment, and we've been pushing for this particularly through the latter stages of last year, is that the RBA has to hike rates. We understand why they're hiking rates. They should have hiked rates actually a while ago. But for all the fears that there are about rates going up, for all the fears that there are about inflation pressures now from Iran and oil broadening out in the economy, the reality is 10-year bond yields in Australia are up near 5%. Do we think that the RBA is going to be raising rates to the point of 5% interest rates and keeping them there for a really, really long period of time? No, we don't. And so we think that there's actually a lot of value in Aussie government bonds. And even if you think that US Treasuries can underperform a little bit, there's a lot of fat in Aussie government bond yields that will allow us to pursue the rewards that are actually on offer there. So this is the reason why we really like long duration assets in Australia and are continuing to rotate our portfolio towards that space. Just a last word on equity market implications. So I've talked a lot about rates. If I go to the next slide. What we do is we can break the world down according to different regimes, and we define those regimes according to what we think interest rates are going to do and all the derivatives therein. So if you think that interest rates are going to rise, but long-term interest rates are going to fall relative to short-term interest rates, that's what we call a bear flattening regime, which is kind of where we've been. And the left-hand table shows you that really where you want to be in are resources stocks, which is exactly where we've been in. Where you don't necessarily want to be in are some of the defensives. However, if you think that we've gone way too far in pricing in RBA rate hikes and actually there's room for the entire rate structure to fall, then the conclusion changes. We go into something that's more akin to a bull flattening or bull steepening regime, and the sector allocation changes quite dramatically. Before I talked about the idea that maybe inflation expectations go up in bonds and real yields come down. Well, what's really interesting if you look at the right-hand panel is that actually favours resources, but it also favours real estate. So what we're positioning for, I guess we've come out of a bear flattening regime where rates needed to rise, and now we're actually going into a regime where maybe we need to think about the other side of that, where rates actually need to fall longer term. And that raises a lot of rotation opportunities, particularly towards higher quality and defensive names. So with that, I might hand it back to April to close off.
I was just thinking before we go to Q&A whether it's worth talking about some of our current thinking at the moment, because obviously we're at very uncertain times at the moment, and we can probably give you some insights into our current way of thinking around obviously oil is the main driver of markets at the moment. They'll have a huge impact on where we go from here. So we spend a lot of our time thinking about oil. How is the Middle East situation going to resolve itself? So we can give you a little bit of an insight on how we think. We think it will get resolved in probably within a week or two, probably is our best guess. There's probably going to be a little bit more disruption in the short term. We've done some various analogues across history, and we look at those, and you go back to 1980, at the start of the tanker wars, where the Iraq-Iran conflict happened, and they turned the Strait of Hormuz into actually a very dangerous place. And I can't remember the numbers off the top of my head, but I think Iraq hit about 285 ships or incidences, and Iran had about 150 odd incidents. So the Strait was an incredibly dangerous place at that point in time. We don't think that's going to happen this time. There's a lot of chatter around, is the Strait of Hormuz closed? Effectively, it is closed to, based off a scarcity of wanting to take risk. The Iranians haven't closed it down yet. We think if they do actually close it down, the weight of the world will go directly on them. So you'll get every nation moving assets there. So we think it'll be short term. So Iran have been very clever with the wording so far around, are they going to shut it down? Are they not? And they basically said they're not shutting it down, with little caveats here and there, but very, very clever with their wording. But we look at the various analogues. So eventually you have to look what will be the response. And looking at the US with Hegseth and Trump, the response will be quite violent, more than we're seeing at the moment. So they are not afraid to use heavy artillery. So it'd be a strategic error for Iran to actually shut it down. So we think eventually this will get resolved, and probably within a week. So just a little bit of context around, conversations we're having at the moment. Even this morning, we had a really big conversation around this. How do you position for it? So we think our best guess, you're going to get maybe one more spike up in oil price, and then that will be it. And then you get some sort of resolution, de-escalation. And then we can go back to focusing on the other worries we have in the market, which are around AI disruption, around job market. How is the labour market going to be hit this year? There's every company we talk to, they're saying we are at peak FTE, no no more hires. In fact, they're going to be fires. So there's going to be real-world implications this year around labour market and what that means for the economy and the share market. And then we've got private credit as well. So private credit, obviously, we went through a period of incredible liquidity post-COVID, writing a lot of loans. All the private credit guys were in fund gathering mode, basically just trying to get the inflows, build businesses. Underwriting was a side thought. Let's just build a business. Those side thoughts are coming back to haunt them now. So we're just got to work through a fair few issues even after this escalation. So it's going to be a pretty tricky year. But as Damien mentioned as well, we're shifting the portfolio around a bit. You might think, why are you going fixed rates when the RBA are hiking, which is a fair question, but we're going really long duration. We think the RBA may make a mistake, a policy error by hiking too hard into a declining market. And this oil shock, it's going to be very small, but it may lead them to a policy error. So I know Hauser was speaking the other night, very hawkish. So, there is risk around the RBA pulling that lever too hard, just as they were too slow reversing their policy from an easing to a hiking cycle as well. So there is real risk both globally and domestically around the market, but I'm not sure if you want to add anything.
Yeah, I mean, one of the things which really strikes us is that last year when the world was cutting rates and the RBA was cutting rates, the number one word was uncertainty. And, we hear that a lot from the RBA, but we hear that also from a lot of other people globally. And I guess an interesting question would be, if you could do it all again, and you knew it was only just an uncertainty shock and not a tariff shock and not a geopolitical shock, would you do it all again? And the answer is, I think most people would say, oh, probably not. But the answer in reality is probably yes. And so what we need to be thinking about is, if you're going to raise rates now, well, that's fine and good to get some credibility and you'll stamp out inflation. But think about it. You're raising rates, and then you've got the tightening coming through at the bowser because petrol prices are higher as well. And then you've got potential uncertainty effects where people start to just hold back on what they're doing just because they're unsure. That's a pretty tricky situation to navigate. And that's exactly what the RBA finds itself in. And these are some of the caveats that Deputy Governor Hauser actually highlighted yesterday. It's not a doom and gloom scenario. I think it's just a matter of being wise and appropriate for the times, recognizing that we've had a few shocks thrown our way. And, on the AI piece, what's also been really interesting is that, through the February reporting season, it was all about AI disruption and the potential, and people were just literally hunting around for who was next to be disrupted. And then suddenly the market's forgotten about that and gone the other way and said, look, we're less worried about the deflation and the disinflation from disruption. Now we're worried about the inflation from oil. And what's really interesting in all of this is that we're swinging around on the equity market in response to news flow and things that should be impacting rates. But actually the rates outlook, at least from an Australian perspective, longer term, has never been clearer. So this is where we see the tactical opportunities to be profiting.
Thank you very much. And thank you to everyone that sent through questions. Before we dive in April, we'll be commencing our shareholder presentations, where we're going to visit 7 cities across Australia. So you can register using the QR code on the screen at the moment. So thanks again for submitting questions. The first question comes from Michael. Michael would like to know what percentage of the equity side of the portfolio is exposed to resources and what is the turnover on the resources allocation?
Resources would be around 14% of the portfolio. And the turnover, we adjust resources quite actively. Resources by definition are quite volatile. So we take tactical opportunities when copper had that amazing run. Obviously we light into that. There's some very specific reason why copper was running. We took advantage of that. And iron ore, generally in iron ore, we pull... iron ore is very seasonal. Like you have good periods where China are buying and the steel mills are running, and then they have some shoulder seasons. So we always trade around in iron ore names as well. So the turnover is quite high. I don't have the number on top of my head, but at a guess, it'd be 1 or 2 times a year on the material side.
Yeah, and we've been very tactical also around energy and oil.
Correct. Yeah.
Maybe would you like to comment on some of those names that you get exposure through those commodities like iron ore and copper?
Yeah, so iron ore, the big ones are listed in Australia, thankfully. So we've got BHP Rio. Rio has been our preferred stock for a long period of time, but that's sort of shifted now. We're a little bit more even between the BHP and Rios. We do have some rare earths companies, Aluka and Linus as well, but much smaller weightings. We've been big in Whitehaven as well. With coal's had a bit of a renaissance the last 12 months. We do have a copper in Australia is really tough to get exposure. Thankfully, within WMEX, we're allowed to invest globally when we can't find an opportunity domestically, and we found a few in Canada that are representing good value and being big project with BHP as well. So we talked to BHP around the project, so we know it very well. But London Mining is one we've invested in on the Toronto Exchange because Australia domestically, we've got the most expensive, I'd say, I don't want to be disrespectful, but low quality assets versus global peers. So it doesn't really make much sense for us to invest in those domestic peers like the Sandfires and Capstones. We can find much better value offshore.
Angela has asked, what's your view on interest rates both in the US and at home, and how does this influence your asset allocation? I know you did touch on it a little bit, but
yeah. So domestically, we're probably with Damien, but one hike, one hike because they're pretty much committed to it.
Yes,
and then even that may be a policy error. What we look at, like, we're not really hugely concerned with the short end. We really want to see how the long end reacts to the interest rate hikes because we've got a theory that it will actually start pulling down the potential growth of the economy, and you might actually get a weakening of the discount rates or the 10-year rate. So the long end's a little bit more tricky, but I think cash rate one more time.
Yes,
and then that should be it. Just looking at the underlying strength of the Australian economy, it's really hit a bit of a wall. So I think one and done.
I think that's right. And so what the RBA is most concerned about is it has an inflation target and it hasn't hit that inflation target for an extended period of time. And so it's concerned not only about, I suppose, the track record, but also how broad those inflation pressures might be. Historically, the way that you get broader inflation pressures is that inflation is high, labour market's tight, people start demanding higher wages without necessarily being more productive. And that is what causes a feedback loop and gets you persistently high inflation. What you're seeing now is a bit of supply chain disruption globally, which is another way that you can get persistence about inflation. And on top of that, you're getting a different sort of feedback loop. So it's not just about the labour market being tight. It's also about the fact that globally we might have greater expectation of inflation, and commodities might run on the back of that. But then commodities running might actually feed back into those inflation expectations. So that's kind of a tricky thing. The RBA seems to be open to tightening in response to that sort of feedback loop, even though it's not its bread and butter feedback loop. And the only thing we can say about that is the more you want to hike in response to those short-term pressures that are supply-driven rather than demand-driven, the more you're just going to have to take back in future years because you've got that double tightening effect of higher oil prices plus the higher rates. So we're pretty relaxed about the RBA outlook. We don't think rates are going away from us. And we're happy to say that, look, rates aren't going to go away from us, particularly on longer horizons, which is where the value is. Now, in the US, it's really interesting because obviously they have a new Fed chair coming in, Kevin Walsh. And Kevin Walsh is not really big on the idea of using balance sheet, the Fed's balance sheet, to do the easing for the economy. He's much more interested in using rates. And when it comes to interest rates, he's made no secret of the fact that he wants to cut rates. Where the US economy is at the moment, you probably can get a rate cut, maybe two, if you stretch it. But you really have to believe in some pretty bearish outcomes to cut credibly below that. Because at the same time that their labour market looks a bit soft, the inflation pressure is elevated, and now because oil prices are higher, it's elevated again. So that the Fed has a little bit of a trade-off, and no surprise, a lot of the Fed speakers that we see coming out are very balanced in their approach, and they're not necessarily suggesting actually multiple cuts even. So this is where the risks and the debate are. Now, what we can say is this: if the Fed decides to cut rates anyway, and not appear as independent as it could be, and do something which is not really credible according to the macro fundamentals, then of course you could actually see a hit to the US dollar as a result of that. That is one scenario, but that's not that's not the only scenario that's out there. Another scenario is that you could get rates fall a little bit and the economy reaccelerates, particularly if some of the global uncertainties go away. Again, that would be very favourable for commodities. Or the last scenario is actually the uncertainty that we're pulling through the system causes such a slowdown that actually everybody agrees that they've got to cut rates. I guess the flavour from what you can tell here is that rate hikes are really in Australia, rate hikes are kind of pushing against the grain a little bit. In the US, rate cuts are kind of pushing a bit against the grain. And we do have a bit of policy divergence happening. But the way to play that, in our view, is through long duration bonds in Australia, at least from a long or buying perspective.
Thank you. We have some questions coming through on the dividends, and we need to preface all of this by saying that it is a board decision. But maybe if you can just give a little bit of extra colour where you can. So Chris has asked, is WMX able to project the anticipated dividend per month following its steady 12-month step up from the IPO? He was thinking, is it going to level out with more consistent dividends per month from middle of this year with special dividends paid when appropriate?
Yes, it's a tough area for us to comment on, but we'll try and flesh it out as much as we can. But given the strong performance, it does give the board some flexibility. But again, because the fund is so young, you sort of want to hold some flexibility up your sleeve as well. You don't want to go too hard early and then the world falls apart and then you have to cut the dividend or anything. So we don't know which way the board will lean, but we've given them a great opportunity to have that choice now, so they could actually increase it if they were so inclined. Special dividends highly unlikely, knowing how the dividends are managed within Wilson Asset Management. It's more smoothing, so I'd say specials unlikely, but the board are in a great position to adjust the dividend from here.
And I think it's important when the board is making those decisions that it is a balance of giving shareholders capital gains as well as dividends. So it is that total shareholder return that is a consideration. So not wanting to go too hard in either direction.
Yeah.
And then Chris has also asked, are further SPPs, so share purchase plans, in the pipeline for 2026 and 2027?
Again, a board decision. We just manage the money. So, I have no idea really on that.
Yep.
But I'd caveat and say we'd like to grow the fund from a manager point of view, but again, it's a board decision.
We have a question on Beach Energy. What are your thoughts and views on the company?
We don't really follow Beach that closely, to be honest. So unfortunately, it's had a pretty rough period, but this oil price is a fantastic blessing for them. So the future does look better for them, basically not through fault of their own, but through the oil price. But the way we play oil is through Woodside. We think it's the best way to play it on the Australian market. So it's got more exposure to spot than Santos, and it's got some potential catalysts on sell downs in Louisiana. So for us, Woodside is the play, but Beach not hugely across that one.
On oil, Greg has asked, where could the oil price go if the conflict persists?
Yeah, we've got we cut it up 4 different scenarios, and scenario 1, it could go to $200. Obviously, that's an escalation. That's a straight shut and an extended period. Our base case, we're thinking, I would have thought around $80 it settles. But in the short term, it should hold around 90, might even go up to 95, 100 again, as Iran won't lie down. They've come back pretty hard about no truce. The missiles are going to send are going to be 1 ton and above now, not the small things. So the war of words is definitely happening. So you could see some tightness still. There is talk of them laying mines in the Strait as well, which are unconfirmed at this point in time. But there has been some footage we've seen of mines in the Strait. So, our base case is it goes up, but worst case, $200, and the world just goes global recession. I mean, and that's why they will not let it happen.
That's right.
So that is going back to our early conversation. The weight of the world would come down on them.
Yes.
Like you'd see every navy in there. So I don't think that's a likely scenario. Very unlikely.
Yeah. And the wording that comes out from the Iranians, again, particularly when it comes to closure, in inverted commas, quote unquote, when it comes to closure, they're very, very careful. And the carefulness of their words shows that they're not necessarily, that they're very aware that in extreme scenarios that they go down, that the consequences for them actually would be quite bad, and it's not actually in their interests. So I think the wording is quite telling. Everybody is very well aware of what those different scenarios are, and they're actually trying to manage it while balancing that with, obviously their own political interests at the moment.
We've got a question from Christopher. Do you enhance income by dividend rotation, as does PL8? And perhaps that he's referring to dividend harvesting strategy?
Not a lever we've had to lean on. And I'm just trying to think of a scenario where we would do that. I think highly unlikely ever to do that. It's a legitimate strategy, but we feel like we've got other levers we can pull, and one being capital growth, not being anchored to income. We can actually pursue capital growth. So, we wouldn't be doing that.
Yeah, I mean, I suppose you'd be looking to you'd have a somewhat bearish view of the underlying equity to do that. And, if you were technically bearish about equities and wanted to just take the dividend but not take the actual capital risk, then you may as well actually invest in a decent bond, which we can do.
Yeah. Yep.
And we've got a question from Paul, who's asked, I thought WMX would be a partial hedge against against the share market, but its price seems to move with the market. Can you please explain?
It's an interesting question. I mean, the share price is determined by the investors.
Yes.
So I guess it's just a reflection of the investors, whether they're bearish or bullish. But the underlying, I think the share price has been quite stable.
All things considered.
All things considered, yeah. But yeah, I mean, it's we are traded on the ASX, and people get to make up their mind every day whether they're a buyer or a seller. But yeah, the underlying portfolio, we get to see that, and it's performing really well. So that volatility, I'd hope through the passage of time would come out as people realise we do have levers both sides.
Yes.
Up down markets, equity markets don't bother us, and high rates, low rates don't bother us either. No. So I think through time, hopefully people work that out. But also I think doing the SPP put a little bit of pressure on the share price too. So obviously once we clear that, I'd hope it would trade a bit stronger versus the market.
Yeah, and going forward, there will be a heavier focus on returns from dividends as well as those ramp up. So, it's important to take a total return perspective.
Yep.
We have a question from Ian. Will WAM Income Maximiser provide an annual summary dividend statement shareholders can use for tax purposes? And the answer is that it doesn't exist right now, but Boardroom are looking into it. But you can access an equivalent tax statement, something similar through your investor serve. So thank you for raising it, and it's being worked on. We have a question from Trevor. Has the current volatility due the ME crisis, I'm assuming Middle East, resulted in you implementing any rebalancing between equity and debt in WMX?
Not specifically, but we've taken advantage of the volatility with a few tactical trades. So, I'm just trying to think. We've increased and decreased exposure quite a few times over this period. Like from the sidelines, these events are really bad. Like obviously the conflict is bad from the financial market point of view. It looks bad too, but we actually love these financial markets because volatility creates opportunities, and we do have a very flexible product. So we've taken advantage of, when the market rallies off some sort of loose Trump tweet around ceasefire, we were fading that. And then when it gets to extremes, when the Australian market was down 4% and a bit, we were buyers. So, it's a little bit reactionary at the moment, but that's the way you have to be in these markets. You have to be very tactical. But as Damien said, and I've said previously, beneath the surface, we are actually ticking up our fixed interest exposure and that long duration. We're out in the market looking for long duration Tier 2 debt at the moment. So that is the underlying trend where we're moving to. But short term, we're very tactical, moving equities up and down quite a lot at the moment. And, we'd be thinking maybe equities, this is might be wrong in 4 hours, but like equities might get faded a little bit from here as escalation. It's not going to be a quick resolution, as Trump said. Like Iran will fight back a little bit more. Equities might fade, and then you'll get the real ceasefire, and equities will rally, and then go back to the issues we discussed around AI, private credit. So there's a couple of tactical trades we can see in the wings at the moment. But yeah, very tactical market, and we're not getting much sleep at the moment. You have to watch 24/7 basically in this market. It's very news flow driven, very headline driven market.
I guess higher level, I understand the nature of the question because you've got oil, which is the shock to both equities and bonds. So how would you choose between two different instruments that are actually in the firing line if oil prices are going up? And that's the reason why we really focus on Australia and the yield pickup that we get in some of those T2 notes. Because if you think that the yield premium that you're getting on Aussie bonds relative to US bonds, and then the premium that you get from being in banks versus government debt, if you think that that's actually big enough to weather the storm, and if you think that there's any uncertainty as to how this is going to resolve itself, such that uncertainty weighs on economic growth eventually, then actually it becomes very clear which way we should be going. And every time yields pop up, it's actually creating yet another contrarian buying opportunity. We haven't gone immediately into bonds and just bunkered down and stayed there. No, we're actually recognizing that there's a bit of a path and it's actually creating some really unique opportunities now.
Matt, you just referenced private credit then. We have a question from Danny. Please expand your comments on private credit. You mentioned earlier as well, private credit providers. Do you see any problems ahead in that sector?
So it's an impossible question to answer, but we'll give our best guess, our base case. There's going to be more issues to come, but we don't think it's systemic. We don't think it'll be a credit crunch, liquidity crunch. But what we think it is a trust issue. Like the asset class was, a lot of money was flowing there. It was like the hot asset classes. At the end of the day, it's just either secured or unsecured lending. It's not really a magic asset class. So it had all this hype around it. So a lot of allocation, a lot of managers growing their businesses, taking as much money as they could, doing some really interesting things in the background. We found out during Liberation Day, like a lot of these private credits were playing in, high yield bonds, and probably not within their mandate, but because they couldn't place it, they were buying these high yield bonds. And then when Liberation Day came, they were big sellers and they caused a big dislocation in the market. So yeah, we're a little bit worried about some of the behaviour, but don't think it's a systemic issue. What we do think will happen, though, is the inflows stop. So they went through a period, let's call it 8 years, or more recently, like really heavy inflow periods, like managers growing, hundreds of billions of dollars of AUM, and not really worrying too much about what business they were writing. That was all about growth because the liquidity was flush. Economic growth was okay. There was no real warning signs. But if we do go into a slowdown, that's to your question, like if we go into a job loss scenario, which may happen with AI, that's when you can really get some issues. So a credit crunch, obviously, a credit cycle will cause a credit crunch. in that space. So that's when you become, there's big losses that will happen in that sector. But at the moment, our base case is not systemic. A few issues, a few pockets of bad loans will pop up. We just work our way through it. Inflows stop, and everyone moves away from that sector as far as inflows go.
Yeah, I think the thing to remember about private credit as well is that it's not like these companies all have immediate refinancing requirements like people had during the GFC. It doesn't all come at once. It's actually very termed out, and there's lots of levers that private credit businesses can pull to manage their cash flows in the interim. So the real issue is not so much on their behalf, like whether or not they can refinance some stuff. It's more about the redemptions that might actually come. And then there's a debate as to whether the issue is, people redeeming because there are losses on the portfolios, and if so, how big those losses are. And most credit funds will tell you that if you're sufficiently diversified towards the high quality and there's not too many issues. But there is another perspective which says that, look, the inflows that you've been getting into private credit have actually formed part of the broader plumbing of the financial system. And so if you don't actually get those inflows, do you continue to see really tight credit spreads and all of that? So we think that there's actually scope for a repricing of credit, but it doesn't have to end like in tears. Like there are things that policymakers can do, and there are natural buffers within the private credit space as well. But certainly the feedback that we hear is that private credit, which is, and this is global rather than Australia, that globally, if you're much more dependent on retail inflows, that sector is definitely under the pump, and institutional is less so.
Yeah, and I guess the other layer, which you may or may not be aware of, is collateralized loan obligations, so CLOs, which are eerily similar to CDOs, which were part of the GFC. So, we're watching that space too, because a lot of that private credit's been packaged up in an on-sol. So that's why if we do go into a credit cycle, there's going to be a bit of pain, but there's pain everywhere for a credit cycle. So it's a really interesting space. But I think, as Damien said, the outflows, the trust has been broken, I'd say, or question marks around the asset class. So that inflow has gone to outflow. It's just like, how painful is the outflow now, which we're watching.
It might be worth touching on the WMX debt side of the portfolio and how this is different to private credit as well.
We don't invest in private credit at all. Everything that we do is in the listed space. So if private credit is an issue, it's an issue insofar as it impacts the listed space, so listed equities, listed corporate bonds, and so on and so forth. But again, we have many levers to be able to protect against this. So if you're concerned about the cycle, if you're concerned that a downturn in the cycle could be exacerbated by private credit, for example, not saying that that's our base case, but let's say that was what you were thinking, then definitely you want to be in the highest quality bonds. You'd be sacrificing a bit of yield from investing in more like triple B stuff, and you'd be concentrating around the AAA. And then if you thought that there would be a chance that interest rates would fall on the back of that, then you'd be invested in longer duration bonds. And so what you would find in that scenario is that credit spreads everywhere would widen, and so corporate bonds would get cheaper in price in the event of a crisis or in the event of a shock. But then you'd be gaining on the other side from the fact that government bonds are rallying, and you're getting that duration benefit. So the bonds that we hold at the moment actually are pretty good that way. They give us that optionality and that protection, even though that's not what's currently front of mind for us.
Thank you. And we've got a question from Peter. Has the value of the bond products WMX holds lost capital value over the last 6 months?
No, because we were mainly floating when we first started. And also we had great entry points post-Liberation Day. I know that's not within the last 6 months, but we had spreads blow out quite dramatically, and that's when we got to place a lot of ours. So we had a really big buffer on credit spreads. So and being floating, we didn't have any of the changes in interest rates. That's why we're making a bit of a change now. I'm going to that fixed strategy because of the way we think it plays out. But no, we didn't suffer any. You get daily movements, but on totality, we were quite in the money on a lot of our bonds as we sold them to go back into fixed. We were well in the money.
Yeah, and I should say also that the way that we set up our fixed income or debt portfolio, it's not just the return that it's generating, but it's also the diversification it's giving us. So the way we're pivoting in fixed, floating, long, short duration, it's actually providing a natural hedge for some of the equity risks that we're taking. So from both performance perspectives and diversification perspectives, it's actually doing its job.
Yeah, and just like further to that comment, long duration equities have been absolutely torched.
Yes.
Fixed is long duration, I think, is the next real winner.
That's right.
From the next phase. So you go through these phases where all the rage was as long duration equity as you could get.
Yes.
And that's been absolutely destroyed by 50%. I don't know whether we can make 50% on the fix, but if we go into this slowdown and a policy mistake, it's going to be quite an attractive area.
We have a question from Cameron. Is the rate of return reference to IPO price, current share price, or NTA? And I understand why they're asking questions because we have referred to a few different ones. The 6.3% that we refer to is on the initial IPO price of $1.50. And in the media release that for Income Maximiser, we referred to a 6.0% number, and that's on the average NTA since inception as well.
Okay.
We also have a question from Murray, who's asked, please reiterate what discretionary refers to. And I saw this question pop up when you were speaking in your intro bit, Matt, as well, after Damien had spoken. So I'm not sure exactly what it refers to, but discretionary.
So I think it's just about, I guess, how we actually actively manage the portfolio and then some of the guardrails. Is that the nature of the question?
I can't recall.
Maybe just define discretionary as well, if that's possible.
We are actively managed. So we have core views that are for the longer term. And so, for example, a core view right now would be to shift more towards bonds than relative to equities. And we will hopefully make a certain amount of return and outperformance on the back of that. But we have also on shorter horizons, rather than looking 1 year out, we might look 6 months out. We might look a few weeks out, and we might trade around that. And so we definitely do a lot on that front. And it comes in different forms, right? It can come in the form of stock selection. It can come in the form of credit selection, credit risk profile, duration risk profile, or it could come in the form of asset allocation, where we can basically pivot very quickly with the instruments that we have between the different asset classes. So we're doing all of that. That's the discretionary part of the portfolio. But that's sort of high frequency, very tactical and opportunistic. We do have our longer term sale. We set up the sales for longer term directions as well.
Yeah, it might be referring to discretionary overlays or discretion, like on the tactical front, which, I can give you a great example last year where we were thinking the RBA would shift from a cutting cycle to a hiking cycle. We were early, which is, I guess you could say, wrong is another word. But the evidence kept building, and we took a tactical position there to take advantage of the market shifting from a cutting cycle to a hiking cycle, and it made a really good amount of money for us, for WMX shareholders, taking that tactical discretionary view around the direction of rates. So I guess that's an example of, you got your core holdings, and then every now and then the market presents these opportunities in front of you that we take advantage of. So that was a clear one. I think that's what it's referring to.
Yeah, and I think also another one would be energy. Like we had a longer term strategic view that inflation risk was probably a little bit underpriced in the US. And so we were naturally long more energy and commodities in the way that we were looking at our portfolio. But then you start to see the number of ships gather in the seas outside Iran, and you'd have to take advantage of that opportunity by playing around with some of the weights that we see there. And as it turned out, unfortunately, we've had conflict there, which is something that we've had to trade around.
Yeah, I guess the other example is, I think it was 11 days ago with the war. It was a Friday night in Australia. It was around, I think it was around 10 p.m., 11 p.m. And we were getting wind of, war was imminent. Like the first strikes were happening, and the great thing about WMX is we have the ability to pull levers, and we went into a protection mode for shareholders. So we took a tactical opportunity to pull out equity risk and increase the energy exposure. So, yeah, I mean, that's another example of we've got the core portfolio, and then we have these tactical opportunities where we can actually protect or make money. And we actually made a decent amount of money on that Saturday. Yeah.
We have a question from Saranjeet. What is the possibility of the USD strengthening? How will financial markets be impacted?
Yeah. Shall I take that?
Yeah, sure.
Okay. So the way that it's currently set up is that from a valuation perspective, the US dollar looks like it's actually quite above its macro fundamentals. Now, that's not saying that the US dollar has to fall in a hurry. It's just saying that that's the valuation position. From a flows perspective, if you see, for example, the view that America is just not as impressive as it once was for whatever reason, and that there are better opportunities elsewhere, that seems to be where the US dollar weakens, and then you see emerging markets, commodities, all of those sorts of things do well. On the flip side, when you have concerns about global growth, naturally people move to the core of the system as opposed to the fringes of it, in which case the US dollar starts to strengthen. And the important thing to note here is, again, the US dollar can be overvalued on a macro basis, but it can continue to strengthen with the right sort of catalyst. So, we think it is fluid. The good news is the fact that the US dollar still responds well when people are concerned about risk in the world tells you that it hasn't lost its exceptionalism. And that's just something that we have to trade around. But yeah, no, it's a great question. Another thing to note is, particularly from an Australian perspective, and this goes back to the RBA, most people would look at a currency, at the Aussie dollar, and say, look, it's massively undervalued at the moment because commodity prices have gone up, we've raised interest rates, the US has cut interest rates, all of those sorts of things. But what's really important to note is that most frameworks for modelling the Aussie dollar and understanding where it should sit have been estimated from the float of the currency up until the financial crisis or a little bit thereafter. And in that phase, we've constantly seen banks go offshore for term funding, which means they borrow US dollars to come back and buy Aussie dollar and therefore support the currency. And we've also not seen in that period a phase of massive superannuation outflows almost in perpetuity to other markets. So what you're seeing at the moment is actually super funds generally park their money offshore now as part of their natural allocations. And banks don't go overseas for their term funding that they used to. And so those two, structurally, you should expect that the Aussie dollar sort of cycles around a lower level than what we've been used to. And the US dollar is a little bit stronger than normal. So that, I think, is kind of a new norm. But relative to that baseline, what you've seen is that the Aussie dollar has started to rise through that new norm, which gives us conviction, actually, that the Aussie dollar is doing some tightening for the economy.
I guess the other way to look at it from a simplistic way is the classic US dollar smile, which you explained perfectly there anyway, but it's effectively the shape, the smile, in the middle where the economy is just going along okay, that's when the US dollar is weakest. When the world trade is booming, the demand for US dollars go up because it's obviously the most traded currency. So a booming economy, you'll get US dollar going up, and then in times of stress, it goes up. So on the smile, the two extremes, you get stronger US dollar, and in the middle, it sort of flat lines. But I'd almost argue the smile is a bit of a twisted smile now.
Yeah.
Booming times, the use of US dollars fallen a little bit.
Yes.
And you probably won't. Yeah, I'd say it's a skewed smile now.
Yeah, that's right. The smile's still there, but it's a little bit crooked in parts. Yeah.
We have a question from George. How much is in your profits reserve, and how many future dividends does it cover? So I've got that helps as well. So it's over 5.6 cents per share in the profits reserve, and that includes the capital reserve. We add to it each month with the passive income that covers the monthly dividend paid out to shareholders. And also on this topic, we have a question from Jill on franking. Is it likely the franking percentage might be reduced as happened in some other LICs? And I think I could say broadly, probably not. And the aim is, of course, for it to be fully franked.
Correct, yeah.
We have a question from John. It looked like most of the gains to date have been from capital growth. Is this recognised capital gains, i.e. sold securities, or is this more of a mark-to-market approach? If it is mark-to-market, how do you determine when to sell securities?
Yeah, when we sell is really when information changes. So, the goal of a portfolio manager is to obviously sell expensive stocks and buy cheap stocks in a simplistic way of looking at it. But we really, like, a lot of them are unrealised so far, so mark to market. But we have taken a fair few profits on stocks that have run too hard. And we, as I mentioned earlier, we do a lot of, I'd call it dynamic weighting. So not selling out completely, but taking partial profit. So let's say Rio Tinto, as an example, I think we had around 8% of the fund for a while, and it went from $120 to $160. And on the way up to 160, the weight, we reduced the weight. So it went down to around 4%. So we halved the weight. So that's just an example. Like, we don't really, sell out completely, but we'll take profits on partial. So you get a mixture of mark to market and realised. So very dynamic weightings.
We have a question from James. Roughly how many stocks are in the current equity portfolio?
In the equities, it'd be around 55.
Yeah,
around 55, yeah.
And James has also asked, how do you trade outside ASX hours? Because you mentioned.
Oh, yeah. So if we want to go into capital protection mode, we can, we could use like a futures contract to take out equity risk by selling some. But like, that's just a tactical. It's not a big part of the portfolio. But like, I'm more thinking that we took the protection out, and then the way market moved. But yeah, the real market moves were on Monday when the Aussie market opened again. But just a little tactical example of how we can try and protect capital at all hours. The Australian futures market is open not 24 hours a day, but it pretty close to it. So if there is a stress scenario and we need to pull a lever, we could take some protection out that way.
And that's true on both the equity and the debt sides.
Yes.
We have a question from George, which is kind of on this topic, which is what percentage of your equity portfolio can be invested in global companies? And I think broadly we'd say that, so the mandate itself is broad and we can invest overseas. And I think from my perspective that you take a dynamic approach.
Yeah, I mean, there's no theoretical weights, but, we are predominantly Australia.
Yes.
So it's really only when we can't find an alternative that makes sense. And in copper, it just didn't make sense. So we had to search. And because this company is doing a big 50-50 JV with BHP, we know it very well. So it's very unique. We bought a lot of the Rio Tinto London line at a period too when the Glencore takeover, because there's a big spread between the Rio Australian line and the Rio London line. And the risk was if Rio bid for Glencore, the Australian line would have got hurt more than the London line. So we were using the London line as more of a defensive play, which actually worked in our favour. But yeah, like, it's just going to be a unique situation. So don't expect to rock up to a webinar and we're 80% global. Like, it's really around the edges.
And the last question we have is from John. What's your view on China's economy?
One of the great debates we have every year. So we just had the NPC meeting, which was last week. 4.5 to 5% GDP growth. I classify it as boring, but boring is probably good for China. Like, it was pretty well accommodative to our thinking. So we think it's going to be another solid year. They had a pretty solid year in 2025, another solid year in 2026, barring any events. All the things the government are doing are pro-growth. Again, like, they're not holding back. The risk was they had a good year and they maybe pull the reins back. They're actually, I wouldn't say accelerating, but maintaining a steady, accommodative setting. So our view on China is quite positive. And we had some recent data out there. We were a little bit worried about the exports to the US, but they've all gone to Europe now. So yeah, the economy, what is their plan? They want to be an AI leader. build data centers, and they're going to go pretty heavy on energy generation again. So, that's why we're a bit more positive on coal too. And property is still in the doldrums, but that's sort of baked in now, and we've witnessed it for 7 years now. So no one's expecting a big turnaround in property. But the economy is still structurally trying to change to a consumption economy. It's a long way away. They've had to lean back on a bit more on the fixed investment, but our view is fairly neutral, I say, but leaning on the more positive side of neutral.
Yeah, if I told you that China can borrow US dollars, the Chinese government can borrow US dollars more cheaply than the US government. If I told you last year that the yuan would be one of the strongest performing currencies in the world, you'd laugh me out of the room. But that's exactly where we are at the moment. So the optionality to do whatever they need to do is actually it's very strong. It's there. And that, even though it's sort of a bit more promise than it is today's reality, that's actually what investors are looking at right now.
Yeah, and we could get even more excited if the Fed start cutting rates by 50, 75 basis points. The PBOC, one of the shackles on them immediately gets lifted. So they're actually set up to be a decent performing economy this year. Yep.
That's all we have time for today. To stay informed with our latest investment insights, please join our community of more than 100,000 subscribers. And you can also follow us on LinkedIn, Twitter, and Facebook, or visit our website for more. A recording of this will be made available on our website shortly, and I'll pass back to Matt for any closing remarks.
I'd just like to say thank you to everyone, for coming on the journey since IPO. It's really pleasing to sit here today achieving all our goals ahead of time. We think this product is incredibly exciting. It can navigate these periods of high volatility and actually profit from them. So, it's a great place to be now. We've got the performance, we've got the profit reserve, we've got the dividend where it needs to be, and now it's, how high do we go with that dividend, which the board will take care of. But it's a great place to be, and look forward to the remainder of this year. So thank you very much for joining us, and hope to see you throughout